So the equity market of China seems to be firing on all engines because it has been ignoring all the bad news, whether it is the US-China trade war concerns or the border situation with the Indian government, or even the COVID-19 pandemic impact that the global economy is likely to face. And there is good reason why I'm saying this is because just today morning, the China market cap in fact hit its highest level since 2015. The Chinese stock exchange market capitalization exceeded $9.3 trillion, and that is a whopping recovery of more than 38% from its this year's low. Now, how does that compare to India? Well, India, the entire market capitalization of the stock exchange is just about $1.9 trillion, and you have a recovery of 45% from this year's low itself. Now, one may argue that the recovery in Indian stock market has been more than that of the Chinese market as well. But that's not the case because if you have a look at or if you have a closer look at the indices, how they have performed, the Shanghai Composite, the maximum drawdown that it actually saw for this year was just about 15% as compared to the Nifty's drawdown of 40% for this year itself. And the recovery has been rather swift and sharp because the Chinese index has in fact recovered almost 30% from its low point of this year, while the Nifty has recovered just about 42%. So it fell less and it has recovered more. That is the broader picture that we are highlighting. Not only that, the Chinese exchange stock market index that we have, the Shanghai Composite, that has in fact touched the highest level of more than 2 years. It is still significantly off its lifetime high levels, which is not the case with the Nifty because we did hit a fresh lifetime high this year itself before correcting significantly, and now once again we are approaching back towards those 11,000 levels. Now, as an investor, what should one do? Of course, you have to look at the valuation picture, being a global investor, and there would be definite comfort that the global investors would see as far as the valuations are concerned. Because if you have a look at the Shanghai Composite 1 year estimate price to earnings multiple, that stands at just about 14x. And that compares quite lower to Nifty's 21 times forward earning price to earnings multiple that we have been trading with. Even for the price to book, that is definitely on the side of the Chinese index. The Shanghai Composite has a 1.5 times estimated price to book value, while the Nifty trades at about 2.4 times estimated price to book value. So this is definitely looking like a long China trade, and that could be a case of resurgence of the Chinese stock market.